Welcome back to the Value Investors Club. I'm your host, Timon Wunderlich. Welcome back to VIC Readings. I'm sorry if I may sound a little weird. My nose is running currently, but let's get right into it. This is only for information, not recommendation. GEO Group Inc. GEO. Filed on September 6, 2022 by Bradford St. Description. GEO Group is one of two for-profit prison operators in the US. I think the stock has a base case outcome of $12 a share by 2024, assuming flat EBITDA and multiple, with an upside case of $18 a share and a downside case of $6.5 a share. The setup is highly skewed due to the significant cash generation at the business even post-debt restructuring. Since the stock was last written up here, the company has A, shut down its construction and design segment, B, completed a debt exchange that averted a possible bankruptcy, and committed to paying down 200 to 250 million in debt per year, 20 to 25% equity free cash flow yield. C, achieved record EBITDA despite a continued federal contract cancellation from the growth in electronic monitoring and prudent cost management. Investors may be missing the fact that electronic monitoring devices, 200 million revenue and 93 million operating income year to date, is now more than half of the contribution of the prison business. 705 million revenue and 174 million 47 operating income year to date. Growth in electronic monitoring has more than offset the decline in prison segment. The recent conversion to C Corp from a right and the shutdown of the construction business segment highlights was what I believe is a transformational change in the business. A transition from a growth-oriented company to a cash cow. In the past, the company received significant negative press for actively supporting policies that would increase incarceration. The new GEO faces an entirely different set of incentives. Shunned by most investors and narrowly avoiding a debt maturity wall, the new GEO is going to be focused on managing its existing facilities, exciting non-core businesses, and focusing on debt paydown. The cleansing presentation filed by the management team in January 2022 showed EBITDA remaining flat at 411 million through 2024 and debt reduction of 200 to 250 million a year. Just 2 quarters later, the company has continued to post strong numbers, and the company is now guiding 523 million of EBITDA in 2022. Note that the previous forecast was arguably sandbagged as it was prepared for debt holders in a debt restructuring context. But I think the general assumption of flat revenue EBITDA is still a reasonable base case. The recent debt restructuring also highlights a perverse benefit of being an anti-ESG name. Debt investors are unwilling to play hardball in reconstructing when they feel uncomfortable owning and operating prisons in the US. The completion of the debt restructuring commits the company into funneling all available free cash flow into debt reduction, which I view as a feature of equity investors. There's no risk of dilutive mergers and acquisitions or growth investments. This company will just focus on cost management and paying down debt. This focus also reduces the risks of the company get caught in more negative press events and is attractive for lenders who are collecting 10% coupons with 10% year forced amortization. GEO is trading at 6 times EBITDA, same as its nearest competitor, on what I consider to be through political EBITDA. The Biden administration has been actively canceling contracts as they come up for renewal. Although a number of these contracts were still renewed, as the government often does not have sufficient space in its own facilities. Although there is currently a desire to reduce the prison population in the US, half of the prison revenue is coming from states and not the federal government. Some Republican states strongly believe in outsourcing prison management, and even some Democratic states, like California, are suffering from severe prison overcrowding and may in the future utilize spare capacity in GEO prisons. In the downside case that the management produces 200 million of free cash flow and EBITDA decreases from 523 million to 411 million by 2024, the company would have an enterprise value of 2.5 billion at 6x and net debt of 1.6 billion. This would still leave a market cap of 864 million or $7 a share, a very attractive downside setup. The book value of land, buildings, improvements is 2.4 billion plus 270 million for idled facilities. So the downside case assumes liquidation at a fraction of the depreciated book value of the real estate, with no value ascribed to the go forward enterprise value or the electronic monitoring business. There are some notable asset divestitures in the works, and we note that the international business appears to be cash flow neutral. If it wasn't for extremely low cash costs on non-recourse debt in Australia, GEO would have exited the business by now. But even the base case of keeping EBITDA flat at 500 million and paying down 250 million a year of debt would leave the stock at $12 a share, a 25% IRR. Notably, the stock would continue to be attractively valued as the company is currently generating AFFO of $2.53 a share. Although debt to market cap ratio is 2 to 1, the company is actually only levered 4x and is expected to be under 3x leverage by 2024. No other company levered 4x would be called distressed. But in this case, the equity attach point is so low that investors are still benefiting from high gearing ratio. And the upside case is that there's a change in the political administration and or continued growth in electronic monitoring solutions. A multiple expansion to 7x with EBITDA growth to 600 million would result in a $20 share stock price. While not assured by any means, this case arguably requires a change of political tone to accepting that most blue states are terrible at managing their own prisons. Many of those prisons are overcrowded and prisoners are unmonitored to the point that no rehabilitation is possible. GEO has long claimed that recidivism, I'm sorry, I don't know, rates from its inmates are well below those from government run prisons. Their claim, I have not verified it, and its prisons are actually contractually prevented from ever exceeding capacity. The political pendulum is currently at one apogee, and GEO stockholders are getting paid to wait until it slowly but inevitably swings the other way. I do not hold a position with the issuers such as employment, directorship, or consultancy. I and or others I advise hold a material investment in the issuer's security. Catalysts. Exit from the new facility construction and embrace of cash flow maximization, debt reduction in 2022. Debt restructuring completed August 2022. Forced debt reduction in 2023 and 2024 to grow market cap by 50%, assuming all things constant. Potential political upside risk in 2024 and beyond. Thank you very much for tuning in. Like I said, this is not recommendation, only for information. See you next time.